Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. You see, back in September 2020, Warren Buffett made a rather uncharacteristic investment. Let us go back to the year 2019 to understand the full story. So in 2019, Warren Buffett's Berkshire Hathaway shocks the world by issuing bonds worth $4 billion denominated in Japanese yen. Yes, you heard that right. The bonds were issued in Japanese currency. Now this causes people to speculate whether the Oracle of Omaha has spotted a takeover candidate. Then about a year later, he issues more Japanese yen denominated bonds worth $2 billion. So in all, he now has yen denominated bonds worth $6 billion or thereabouts. And then the very same year, Berkshire Hathaway invests almost the equal amount in 5 Japanese trading houses known as Sogo Shosha, which makes him one of the largest shareholders in these companies. Now herein lies Warren Buffett's genius. All the 5 trading houses, that is Itochu, Marubeni, Mitsubishi, Mitsui and Sumitomo, all of them had dividend yields ranging from 2.3% to 6.2% at the time Buffett bought stakes in them. And did you know what was Buffett's borrowing cost for his yen-denominated bonds? Well, it was in the region of a paltry 0.5% or thereabouts. Yes, that's correct. By borrowing money at just 0.5 percentage point and eliminating any currency risk, Warren Buffett was able to buy stakes in centuries-old Japanese trading houses sporting a dividend yield of anywhere between 2.3% to 6%. And by the way, we are not even considering the capital appreciation here. With the help of annual dividends alone, Warren Buffett ensured that he made significantly more than his cost of capital, which in this case was just 0.5 percentage point. Of course, the only risk in this case was a significant crash in the stock prices of these companies. However, as investors, you need to make such low-risk bets if you want to earn great long-term returns. Well, Warren Buffett will no longer have to worry about the stock prices crashing. If reports are to be believed, all the 5 stocks have moved up 50% to 70%, handing the Oracle of Omaha gains that are simply off the charts. Once again, Warren Buffett's approach of having a low-risk investing mindset and ensuring a big fat margin of safety has paid off big time. He has really killed it with his Japanese bets. Now, one disappointing or a negative aspect of this investment has to do with its relative size. You see, although an investment of around $6 to $7 billion may look like a big deal for majority of investors, this is not the case with Berkshire Hathaway. Berkshire Hathaway has more than a $100 billion cash deployed in US Treasuries, and this together with the market value of Berkshire's other investments makes the Japanese bet look very tiny indeed. It does not move the needle of performance a great deal as far as Berkshire Hathaway is concerned. Now, if this is the case, then why make that deal at all? If the investment has not made any significant difference to the overall performance of Berkshire Hathaway, what prompted Buffett to go ahead and still do it anyway? Well, another successful investor who answers to the name of Mohnish Pabrai has an answer to this conundrum. And I strongly believe that Pabrai is right about this one. In a recent interview, Pabrai recalled how Charlie Munger once told him that Warren Buffett has a very large brain. And this brain needs to be active in a manner that is not detrimental to Berkshire Hathaway. So while the Japanese bet may not have done anything to propel Berkshire Hathaway's returns, what it did was to soak up brain power for Berkshire. Now, what Charlie Munger is saying is something really interesting. Warren Buffett is a voracious reader as well as a thinker. In other words, he has this huge appetite for evaluating and making investments. And if this appetite isn't satiated from time to time, he may end up making an investment that will prove very damaging for Berkshire Hathaway. He may end up taking risks which he should not be taking. And therefore, in order to douse this fire, it is very important for Buffett to keep making these small investments from time to time. After all, even Warren Buffett is human and does not have unlimited reserves of willpower. Therefore, instead of testing the limits of his willpower, it is important that he is given something to do. And this something to do can be the small Japanese bets that he made back in 2020 and where he earned fabulous returns. To be honest, I had never thought about Buffett's small investments this way, and it does make a lot of sense to me. After all, when it comes to investing, our biggest enemy is not some outside entity, but our own biases and impulses. And one of the most notorious of these biases is what is known as the action itch. I think it was Blaise Pascal who once quoted that all men's miseries derive from not being able to sit quiet in a room alone. Well, I don't know about other miseries, but a lot of the misery in investing derives from always wanting to do something. If the market is going up, we feel like buying stocks by the fistful. And if the market is going down, we feel like selling. Therefore, as investors, our biggest challenge is to try and stop this action itch, this tendency to frequently have something to do as much as possible so that it does not end up damaging our portfolios. Now, Warren Buffett found a way out by making small investments relative to the size of the portfolio. Is there any such method available to us retail investors? Of course, there is. You see, a great way to deal with this situation is to keep varying the allocation between stocks and cash or cash equivalents in our portfolio. So, if we have rupees 100, we start by allocating rupees 50 each to stocks and bonds or fixed deposits, and then vary it after every fixed percentage rise or fall in the market or at periodic intervals. So, if the market goes up by say 50%, we move money out of stocks into bonds, and if the market goes down, we move money out of the bonds or FDs and into stocks. This will ensure that we have something to do every few months. As Ben Graham once opined, these activities will provide some outlet for our otherwise too pent-up energies. I am happy to share that I have been using this technique in my Microcap Millionaire service with encouraging results. I never recommend my subscribers to be 100% invested in stocks. I take the decision on the overall corpus based on the broader market valuation. So, if the Sensex PE crosses more than 25 times, which is significantly higher than its long-term average of 20 to 21 times, I recommend my subscribers to move as much as 70% to 75% of the corpus into fixed deposits. And if the Sensex PE goes significantly below 21x, the proportion is reversed, that is 75% stocks and only 25% fixed deposits. I recommend them to make this switch once or twice a year, thus giving my subscribers an outlet for their pent-up energies. In other words, I give them something to do every few months. As of doing this video, this technique has allowed Microcap Millionaires to earn returns of almost 350% since inception versus 156% earned by the Sensex during the same period. Let me repeat that, almost 350% for Microcap Millionaires versus 156% for the Sensex. Now, the reason this strategy has worked is because it has allowed my subscribers to be greedy, that is, increase the allocation to stocks when the rest of the market was fearful, and be fearful, that is, reduce the allocation to stocks when the rest of the market was greedy. Therefore, instead of being 100% invested in stocks at all times, I would strongly recommend that you vary the allocation, that is, have something to do every now and then. It will not only provide outlet to your pent-up energies, but it will also allow you to be greedy when others are fearful and fearful when others are greedy. A 50% allocation to cash or fixed deposit may sound like an outrageous idea given how all the stock market gurus and experts want you to be 100% invested in stocks. But trust me, it is one of the safest ways of putting together a market-beating portfolio for the long term. It prevents you from committing the big mistake of putting a lot of money to work at the top of the bull market and exiting in panic after a big stock market crash. Not to forget that it allows you to buy and sell stocks from time to time and satisfies your urge to do something. What do you think of this approach? Do let me know in the comment section, and please do not forget to like and share the video in case you have found it useful. Until next time, goodbye and take care.